So a lot of things happening here at Market Radar. Obviously, the big thing that we've been working on is a model refresh, and we've been putting a lot of time and energy into this. Some really phenomenal things have come out of it. We're not quite ready to publish, but that we're pretty much at the end stage where we can openly talk about it, and we will be updating the daily quant deck, which is our daily report for our members, with these new model refreshes and shipping them quite soon. So, yeah, here is the new Aries. This is the
It's absolutely ridiculous.
yeah, it's to be honest with you, man, like it's almost unbelievable. But trust me, we more than quadruple checked it. The only reason that the total return at 50 million% is retarded high is because the model actually does have a very high CAGR that's sustained for 30 plus years. Um, and it really you're running 3 times leverage on that, so you end up with something stupid. Now, is that a guaranteed future result? Obviously, past performance is not indicative or guarantee of future results. But the idea here is, if the rules continue to work, this model should perform exceptionally well in the next in as we go forward in time.
Yeah, and that's an important thing that we always focus on ever since we started Market Radar is we do not overfit models. It's very easy for someone to just say, okay, if you just look at a bunch of data, okay, if you do exactly this over the last 30 years, you're going to have 100% CAGR, just because you're following a specific rule that was created and fitted for the data that you see. So
Yeah,
that's a thing
yeah,
that we strive to not do. So this is not fitting data at all.
yeah. That's a good point. So, like for example, we decided to dig our toes in and do some more research after this last bond fiasco. We didn't, for some of our members, they saw that as bonds going down in our face, but we were long bonds from early July, so we actually walked away from the trade profitable. We left quite a bit of gains on the table, but we were like, okay, you know what? Maybe there is some sort of optimization we could do, and sure and behold, lo and behold, we have come up with this. But long story short is like after all this optimization, the Aries model is still with leverage is still in a 20% drawdown, right? So it's not like we took this opportunity to figure out how to negate the most recent drawdown. And there are multiple 20% drawdowns in Aries that that just happen organically. We don't sit here and try and say, okay, we need to avoid a drawdown in '01, in '08, in 18, in 22, and in 24. Like that's not how sports we just here. We simply just try and make the model as a whole better, using pure common sense logic in terms of the signal approach, and more so a balanced view, and not so focused on a certain time frame or a period where we were trying to almost perfect the trades. But with that said, I need to drop some context here on what Aries is and what's changed in Aries specifically from our original model. So before I break down what's shifted, let's actually look at the original model. And what you'll see here is this is the original Aries, the live Aries, which the members, you guys can see this in the report. You'll see that Aries has a 3 times leverage CAGR of 28.51% and a max drawdown of 52%. The new Aries has a CAGR of 48% and a max drawdown of 47%. So what's happened here? What Obviously the total return went from 400,000% to 50 million%, some retarded jump, right? That is very visible. But what actually changed in the model here within Aries? So the big change was Aries in the current model was not effectively, or I should say, yeah, effectively is the right word, utilizing and capturing risk off regimes. We were capturing a lot of noise and risk off where we would get these bond moves, but we wouldn't keep the meat of the bond move over time. Or maybe it was, risk off would trigger, you would have a massive run, and then risk off would kind of peter out, and you would be trying to exit the bond position, but bonds move so quick in both directions, they kind of whipsaw, and you get whipsawed up, and then you get whipsawed down and out, and you didn't really lose money, but you kind of left a lot of meat on the table there in a general risk off. So what we did to optimize this was we isolated the real weakness in Aries, which was risk off. And we looked back and said, okay, where can we make Aries better in risk off? Just isolating risk off to start. And the big fix that we found was in the periods where the system falls into risk off but is not deep. So think of, the growth scale from 0 to negative 100%. Negative 100% is extremely confident in negative growth or risk off, and 0 is neutral. When you fall from 0 to negative 50 in that range, you have to be more dynamic with your defensive plays. And Aries has incorporated a more dynamic defensive play approach. We did explain this in the prior podcast. So if you're really trying to learn more of what that is, just go to the last podcast, and that's all broken down there. But long story short, we expanded the defensive area for Aries to play in, and we limited the pure risk off / recession bond exposure in the model. And with that, we automatically saw a vast increase, or I should say a noticeable increase in results. And by doing that, we were able to remove some of the scaling features of the model. So this is another thing that has contributed to the massive gain in performance in the new Aries. The current Aries model has a scaling feature where if the second derivative of growth basically is moving down, so basically falling apart, it's going to happen before the first version. So call it like a second layer, right? Like a sub-layer growth. If sub-layer growth or second layer growth is falling and it goes to 0, and the main growth index may not be at 0, maybe at 50%, whatever it is, the model will automatically size down from 100% allocation to 25% allocation. And because risk on can be very volatile, what ends up happening is we've seen with the testing that the scale feature does help reduce some volatility, but the amount that it reduces the volatility by versus what it decreases the upside capture by is immense. So therefore, we actually just removed the scaling, and by implementing the enhanced risk off parameters where we take those more defensive plays in the shallower / slowdown environments, that has allowed us to keep full capture of risk on to the upside, and that volatility is offset by the stabilization from the slowdown. So long story short, we added a couple of more holdings to Aries in a certain phase of the economic cycle, and therefore we can stay fully risk on to capture more of the upside. Those two together give us these crazy results in Aries.
Yeah, and what's even crazier is RQF is even better. So RQF, now we decided to retire Hercules. So Hercules, our short volatility model, is no longer part of RQF. And the reason for that is it just didn't make the cut. Now that Aries performs the way it performs, it's really not worth putting capital towards Hercules when you can put it towards Aries and put that money to work better than what Hercules could have done. So
Right.
now
So
RQF is 80% Aries and 20% Astrius, which is our Bitcoin model.
right. So I want to break down also what the difference there is in terms of Aries, right? So RQF is running 80% Aries on 3 times leverage. So if you look at Aries, right? Aries is has the Aries model, and then we have it levered up 3 times. And the levered up 3 times portion, we're taking an 80% allocation of the Aries levered 3 times, and we're taking a 20% allocation of our Bitcoin model, which we don't have on the screen here. There were some noticeable changes, but it wasn't enough to merit it being jammed into a podcast where we're trying to keep everything nice, short, and simple. So, long story short, there RQF has that updated component of Aries, and because this Aries has a 48% CAGR, for those that don't know this, the short volatility model only had a 20 something percent CAGR. The old Aries had a 28% CAGR on 3 times leverage. So if we take a look at Hercules right over here, right? The current Hercules has a 24% CAGR. So if you look at it from a 28 to 24%, it's almost balanced to where it makes sense to integrate Hercules into the model because it's competing at a similar level, slightly less than Ares, but not so much different. But now when you have a 48% CAGR, like Artie, you just said, putting a 24% CAGR model in there to balance out Ares when in reality they're both going to be risk on models is nonsense. We're better off just dropping Hercules and concentrating that money into Ares. And that's what the RQF does. And in turn, with the RQF upping the allocation from 60% in Ares to 80% in Ares, that 20% would have been in Hercules that's dropped, and the other 20% in Asterisk, which is our Bitcoin model, you are now left with an 81% CAGR since 2016. Now, some people might say, oh, well, that's Bitcoin. Well, to be clear, our Bitcoin CAGR did go up, but the allocation is still at 20%. So if we look at the Bitcoin model right now, the Bitcoin model has about a 70 to 80% CAGR. This CAGR is higher on the new models, but it's not a significant move. We're only holding 20% in Ashes. That hasn't changed. The big jump in RQF actually comes from Ares. And by us allocating more to it, we get to capture more of that higher CAGR, merge that with all the already amazing, Bitcoin CAGR for what it is, without upping the Bitcoin exposure. We're left with a ridiculous CAGR and quite competitive drawdown stats and a competitive beta to SPX. So this is like a really big update for us. We're able to dramatically lift the total return, the annualized return, while keeping the risk of it all somewhat stable and competitive against the S&P, which is, for us, that's the key here. How much can we lever up versus the benchmark without underperforming the benchmark, or I should say without experiencing worse downside than the benchmark, at the same time experiencing significantly higher upside. And that's what RQF's
And
intentions are, and that's what it does.
the beauty of it too is with a CAGR this high, you don't need to run 3 times leverage to make exponential returns. Even 2 times leverage, you're going to be way outperforming the market. So it's pretty cool. I'm excited to run it. I know there's going to be a lot of doubters because this is literally like medallion fund performance. But people can doubt us. We're going to run it real time for everyone to see.
Yeah. Now I do want to say, let's be a little bit realistic here. The CAGR of 81%, I think you and I both know, that is beef. There is some juice in there from Bitcoin for the last couple of years, the way it's moved, right? There
Yeah.
is some
Like
juice in there. So
Bitcoin's not going to double as easily as it was able to when it was, 20K.
right. So the idea, I mean, it could, right? But the idea here is that those returns likely won't be linear. If they are, great, good for us. We're running the strategy, but our expectations are we do see this CAGR drift lower. Maybe closer to the Ares. I mean, this is a 48% CAGR since 1991. So this is a 48% annualized return since 1991. This is probably more of where 40 to 50%, if we can land there on RQF. Ideally a bit higher, maybe 55, 60%. That's more realistic with what I could see this, idling out in the next couple of years. But that's all, imagination, right? Like the question is, even if you can get a return close to this, you're talking about something of 4 to 5 times the annualized return of the S&P 500. So it's quite phenomenal. The only question is again, a lot of people will doubt this. They will look at this and say this is impossible. And again, like you said, we will trade it. They'll doubt it. We'll trade it, and we'll see how this works out for us in the long run, as we have been since day one.